mortgage to me for my house, keeps the mortgage on its books, it has to hold more capital against it than if it sells the mortgage and instead holds mortgage-backed securities on its books. Now, people respond to incentives, and that led to more securitization and to the banks holding more of these securities. And then, of course, when things went wrong, everybody was in trouble. Banks that thought they had very safe securities, AAA securities, turned out to have what they now call toxic waste. Term of art, toxic waste. Okay, you kind of pulled me into the rest of the talk, which is that ultra low, ultra easy, accommodative, low interest rate policy. The easiest way to see this is just look at the interest rates. For 3 years, interest rates, it's during this time period. For 3 years, short-term interest rates were at 2% or below, very low by historical standards. And for 1 full year, they were at 1%. And during that whole period of time, interest rates were, a little jargon, negative in real terms. That is, they were below the inflation rate. Now, in effect, that meant you were paying back a value, a sum of money by borrowing that was worth less than what you had borrowed. And in a way, you were being paid to borrow. So you get a lot of borrowing and lending going on in those circumstances. And when interest rates are very low, it tends to also squeeze risk premiums out. In other words, there's very little money to be made by lending on perfectly safe assets at 1% and 2% interest rates. So people start to look for a little bit higher yield, which means they begin taking on a little bit more risk. And there's so much credit going through the system that they're driving down the returns on the riskier assets. So that what's called the risk premium, the difference in the return between a risky asset and a safe asset, is being compressed. Plus you had these mortgage-backed securities that were yielding more, were rated AAA, and it looked like you were getting a free lunch, that you could get a higher yield, higher return at a AAA that is nearly no risk situation. Well, it turned out to be all untrue, and it turned out untrue, and I'll give you one generic explanation, because the game couldn't keep going. To go briefly to back to the subprime, the way the subprime mortgages work, and I can go into this in more detail if you want, but the way they work is it only works if housing prices keep going up. Now, housing prices don't keep going up anywhere, not even in Southern California. I had friends that were, does anybody know what it means to be underwater as a homeowner? Your mortgage is now has a higher value than your house, that's being called. They were underwater in their home in Southern California for 10 years. That hot markets also crash. And so the idea that housing prices would always go up, and of course the subprime mortgages grew most rapidly in the areas with the hottest housing markets, hence the markets most susceptible to the biggest crashes. Greenspan said he never heard of housing prices going down nationwide. Well, he must not have ever read about the Great Depression, because the exact same kind of housing market went on in the 1920s and then crashed in the 1930s. I'm sorry.
Is a crash equivalent to a rationalization market?
Well, sometimes it is, yeah. So the housing prices didn't have to start going down. Of course they did. They just had to stop going up, which they did by 06 or 07, depending on what markets you're talking about. That the house of cards would come down. The other thing that couldn't go on forever is interest rates at 1% and 2%. So to say, as Greenspan and Fed officials have said repeatedly, they didn't know that this was a bubble building up. They didn't realize this was an unsustainable situation. It means there was a total absence of a sense of history, and since Bernanke emphasizes that he's a student of monetary history. He can't say he didn't know. Right. So what was going on in their head, I don't know. When people ask me that question, I say, I got my doctorate in economics, not in psychology. I just don't do that.
Isn't that exactly what they're doing again?
Yeah, right. That's very good.
To me, it seems illogical.
It's logical in the theory that if you have a hangover, the cure for it is to have a drink. It will relieve the pain, but it just means you crash again worse later. Yeah, that's true. They are doing the same thing again. And by the way, the origin of I think it's a good question, because I said this low interest rate policy began to be implemented in 2001, and that's when the subprime market began taking off, and that's when the securitization of mortgages went from 50% of total mortgages to 80%. I know the reason that Greenspan responded there, at least I know why he cut rates. It was in response to the dot-com bust and the collapse of the stock market. The economy actually started going into recession in 2001, before 9/11, but after 9/11, I mean, it was a disaster. And so, arguably it was appropriate to cut interest rates to something for some period of time, but to hold them low until around 2005, I think not. So there may have been an initial rationalization, and I guess he felt like he got away with it. He said, gosh, I got the rates down to 1% and the world didn't mend, so why don't I keep them at 1%? Well, because this is an historical anomaly, and it couldn't continue. But it did. Well, where I kind of end up in the paper is I go through a whole succession of financial crises that occurred in a period in which central banks around the world, beginning officially in 1989, the first bank that adopted inflation targeting was the Reserve Bank of New Zealand. And then it became accepted practice in central banks in Great Britain. The Labour government instituted it when Tony Blair was elected for the first time in 97, I think. And it's written into the statute for the European Central Bank. Now, the Fed and the Bank of Japan never officially adopted inflation targeting. Inflation targeting is the idea that the central bank will pursue a low rate of inflation. The Bank of Japan and the U.S. never officially did it, but most people say they had a tacit target. They had tacitly done it. And this was supposed to give a much more stable monetary policy. But think of all the financial crises that have occurred during the period that inflation targeting was coming in. And it was already instituted in the U.S. by Volcker in '82, Paul Volcker. And it was being instituted around the world. You had the Japanese property bubble of 1985 to 1995, from which they have never recovered. It was a property bubble, and it was a Nikkei bubble. It was a stock market bubble. The Nikkei just hit a 26-year low in the last 2 weeks. The East Asian financial crisis of 1997, the Russian and Brazilian crisis of 1998, and the Argentine peso crisis. I'm just dealing with the international ones. Now, the reason that inflation targeting is relevant for all these is the 85, 95, you have the BOJ. But the East Asian financial crisis in 1997, 98, many of those Asian countries pegged their currencies to the dollar, so they were importing U.S. monetary policy. The Russian and Brazilian financial crisis, many of the lenders to these countries were banks domiciled mainly in the U.S. and the European Union, were domiciled in countries in which the central bank was engaging in inflation targeting. And the Argentine peso crisis, I mean, they had a hard peg to the dollar. They were dollarized. It was a 1-to-1. The peso was equal to $1. So you had all these global financial upheavals